Today is June the 15th, and we are in the middle of the month of June. And this past week, there were a few key points to look out for among traders and investors. First of which was the outcome of the talk between the US and China in London over their trade negotiation. There was no trade agreement. However, they came out with a framework to deal with further negotiation. And then in the middle of the week, we have the release of the CPI numbers followed by the PPI numbers for the United States. Those were not market moving. However, the single piece of news that actually moved market dramatically was news that Israel carried out a preemptive strike against Iran. That has market gone into chaos. We have seen the price of gold actually surge to challenge the all-time high at $3,500 per ounce, although it did not quite break that high. And we also saw the dollar momentarily dipped into new low, the lowest we have seen in the last 3 years. We have also seen perhaps the most dramatic move in commodity in regards to energy products. We saw crude oil, whether it is the Brent crude oil or the WTI crude oil, all surged by more than 7%, with the WTI briefly breaching the $77 per barrel. Now remember, just a fortnight ago, oil prices was trading in the mid-60s. So that was a big move. And today we're going to spend some time to talk about the impact of the oil market and where I think oil is heading. To give you an overview of the longer-term time frame, you can see that what's in front of you is the weekly time frame for the micro WTI crude oil futures. This is a continuation chart. The current most actively traded contract is the July contract. And just to give you a little bit of perspective, for the week itself is up almost 13%, and for the month itself is up so far 17.12%, and for the year to date it has turned positive for the first week, up 1.82%. So this is the current situation as far as this week's performance in the crude oil is concerned. Technically, we can see that the weekly time frame still is biased towards the downside for crude oil. We can see the high traded was $129.43, traded just before, or rather just in the initial stages of the war in Ukraine. Remember, Russia launched their special military operation in February of 1922. That was a high of $129.43. Since then, crude oil prices has been deliberately being kept, and it traded to as low as $55.30 just last month. Okay, so you can see that prices currently, due to the news that Israel has launched a preemptive strike against Iran, caused crude oil prices to surge this past week to as high as $77.62 per barrel. Technically speaking, we are beginning to see what looks like to be a very, very aggressive move to the upside. This is seen currently to be the counter trend to the larger degree bias to the downside. So basically, this again is a counter trend to a very established bear market, okay, which will remain in force until $123.67 is taken up. So for the time being, as aggressive as the move we have seen over the past weekend, we can see that this as a corrective pattern for now, okay? Now, to get further insight as to whether this counter trend is sustainable, we want to also see that there is that invincible line here, which I have drawn that simulate the resistance line. And you can see that last week itself, we have a breach of this line. Although on a closing basis, it did not quite breach this resistance line. So we want to take a look at the lower time frame to get a sense of where we are heading. And for that, we will be looking at a daily time frame. Like I said, this move that we've seen on Friday is very, very aggressive, with crude oil trading very impulsively to $77.62 before pulling back to trade somewhere in the lower end of $73. Okay, so based on the structure itself, it does look like there is a possible 5-wave pattern that we can see here from the low of $55.18. So this looks like a potentially very impulsive move, and I, for now, would be labeling as a 3, okay, meaning to say this is the most aggressive part of this move, and I do expect a little bit of pullback which has already occurred, okay. So I'm not sure whether it will continue to pull back, and whatever the case is part of a fourth wave before we see market resuming its rally beyond $77.62 over the next few days, if not weeks. Okay, so this is my outlook. I still think that this market is lower to buy with a initial target of $81.40. Okay, now this is the 4 hours time frame. You can see that the 4 hours has already turned positive, and if we do see further pullback from the height of $77.62, ideally into this bracket of prices between $66.72 to $69.54, that will be a great area to pick up some more longs for the possibility of a resumption of this very impulsive move, possibly targeting $81.40. So this is based on the 4 hours time frame. Now, in the 1 hour time frame, you can see that the pullback from $77.62 now has lost some momentum, and there is a possibility that we may see further pullback. Although I do not put a lot of capital on it, the market could very well resume its rally. And but if it does pull back into this bracket of prices, which in the lower time frame, such as a 1 hour, can detect an area of possible demand at $68.49 to $69.54. Although the better place to buy will be anywhere below $67.60. But again, we take what the market can give. And if we do have a pullback into this bracket of prices, like I say, $68.49 to $69.54, that will be a great area to position along, in my opinion, putting a stop just below $66.70. Okay, so I think given the possibility of a run up to $81, this is actually a very low risk trade setup that I've seen for myself. This is something that I will possibly do, not a recommendation, but considering the volatility in the Middle East and news that over the last 24 hours and 48 hours, we've seen there has been retaliation by Iran on Israel, and Israel on their part has also launched another wave of strike against not only their nuclear facilities, they are also hitting the Iranian oil fields. Now, this is in particularly very concerning because if the oil fields are hit and go out of commission, it will definitely cause another run-up in oil prices. So by and large, whether we are looking at a fundamental or looking at a technical, this is a market that is lower to buy. That's in my opinion, of course. All right, this is all I have for you, and I shall see you in the next update.